Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. This is Real Estate Risk Report. As always, I am your host, Lance Pederson. Thanks for joining us. So today we have sort of a first of a kind guest, Shahin Yazdi with George Smith Partners, based in Southern California, right?
That's right.
Yeah, so it's sunny Southern California, whereas we're preparing for sort of snow apocalypse up here in Portland. But so yeah, this will be the first time we have someone on that is sort of more fully entrenched on maybe the debt side of the house, or George Smith Partners really, they do a lot of transactions in a given year, so they're kind of behind the scenes, that you don't necessarily know they're there, but they're the ones that are sort of brokering a lot of these and putting the capital stacks together and making these transactions possible. And, these days, the number of options in terms of where you can source that capital is myriad compared to probably what it once was, and it's very, as we discuss oftentimes on this show, it's very relationship oriented, right? You gotta know people, you gotta have relationships with them. And that's really where you can drive value. So often you hear people speaking of brokers in terms of, those who are on the sales side, right? Trying to help, buy and sell properties, but is as important, if not more important, right, is those who help figure out how to get these things to pencil. So with that said, why don't you share a little bit about with us about yourself and, kind of how you got into this space and, and how you ended up landing at George Smith Partners, and maybe just give us a little thumbnail sketch about, your day-to-day sort of what is you're working on and what's that look like?
Sure. And thanks for having me on. I really appreciate it. So I got into this business, almost 17 years ago now, 16, 17 years ago. And I got into the banking side of it first. Loved it. I started a bank called First Republic, which is more of a private bank and caters to like high net worth individuals and companies. I loved the real estate side of it, and eventually just realized all I wanted to do was structure debt and equity. At that time, it was 2007 when I made that decision. And that's when CMBS market was just on fire, and just the real estate market in general was just going crazy. And so I joined George Smith Partners. Eventually, I started my own team. I started working under someone else. And then by 2015, I became a partner here. And in 2017, I became one of the managing directors. And now there's 3 managing directors running the day-to-day operations of the company as well.
Cool. So an average day, then you've got a team of people that are out that have sort of building relationships with developers or operators, or it's how does that kind of look? You got to cater to both sides. Like, hey, it's the debt and equity providers. You got to have those relationships, and then those who are out sort of building the relationships with the operators or the deal sponsors. Or
exactly. I always say we have 2 clients. We have the sponsor and the developer, and then we have the capital, whether it's a debt fund, a bank, or equity source. We got to cater to both of them, make sure we're meeting both their needs. And that's why we're very diligent in our underwriting. When we do take on a deal, we'll underwrite everything ourselves. We'll create a full deck to make the capital provider's job a little bit easier, helping them understand the deal. And then we go out to market with that information and find the best source or the best structure. We're doing a lot of deals now. They're structured deals, so there's more than one layer of capital to it. It's not just like a traditional bank loan, although we do those as well.
Yeah, because it gets pretty crazy. I mean, these days, right? You've got your senior debt, and you can have some preferred equity from some more institutional, quasi-institutional source, and then even then down at the equity side, the LP capital. And so you guys will sort of, mainly, is it in the senior pieces and the mezzanine or the preferred layer? Or do you guys source do you help source like LP equity as well? Do you make those connections, or is that?
We do LP equity, co-GP equity. So you could layer in a deal with so many different providers that as a sponsor, for like a $30 million deal, you could be putting in as little as like $100,000. If you're getting a co-GP, an LP partner, and then, high leverage debt with that. And we're involved in every piece of that capital stack.
Got it. Yeah. So let's kind of touch on I guess start at the high level, like with the debt providers. How would you bucket, where this debt is coming from these days? Like on most of, let's just say it's a value add multifamily deal, which seems to be, the most abundant. So when you're going out there, it's where is that? Like, who are the main players? Like where are you sourcing that kind of debt from? Are these like private equity real estate funds or like debt funds, or is it more of like insurance company? Like maybe just give us some insight into how that world kind of, works.
So let's look at a value add multifamily deal, for instance. You're going to have the banks that are going to be players in it, your regional banks. Typically, they're going to look for recourse. They're going to get somewhere around 60% to 65% loan to cost. Then you're going to have, and then the other big player in that space, which these days are debt funds. And they can go non-recourse. They'll get to, 60, I would say 70 to 80% of cost. So basically, you're able to lever up with the debt funds, and it's non-recourse. Pricing on non-recourse loans tends to be less. You're going to be somewhere around 250 to 350 on a recourse basis, whereas on a non-recourse loan, you're going to be around L 325 up to like L, LIBOR 400, even up to 450. Yeah. With a LIBOR, and then, of course, where you floor LIBOR is going to determine your rate.
Yeah, exactly. So if you want to go into a deal where someone's not having a PG it's going to be 100, 150 basis points more, right?
Basically, yeah. Typically, that's what you're looking at. In some cases, it could be the same, but generally, it's going to be a little bit more for that. But then you get more leverage as well, so it makes up for it. And I always say, like, the debt funds, people should think of them as cheap equity. If you bring in an equity partner, you're not only going to split returns, they're going to look for a specific IRR, whereas the debt funds are just getting their rates, and, they could get pretty high on that capital stack.
Yeah. And when you peel back the debt fund too, and maybe you can speak to it, and I'll sort of just frame it up here, but, a lot of these debt funds, so when you go upstream there, of course, the debt fund is lending the money on these terms as we just laid out, which is, pretty competitive. But at the debt fund level, what you're usually seeing is they're usually levered themselves through some, specialty lender or, some other institutional sort of capital that's coming in and putting on a credit facility or whatever. And they're advancing, I don't know, let's just call it 65 cents on the dollar. Right. And so then they're coming in with LP capital into the debt fund at, whatever the remainder would be. And, so that's where, to the end user borrower, it might be paying, like we said, 6-7% or whatever, but upstream, with that leverage, the LP capital, that's kind of the beauty. That's why debt funds can be great. If you can get your mind wrapped around the leverage at the debt fund level, one thing that's nice about it is it's sort of more of a fixed income replacement stream to that investor, if you can get in on that, right?
Exactly.
The interest income's coming back at you, and not the most tax efficient, sort of thing, but it's better than a stick in the eye at like 0% interest. It's a good return if you get comfortable with the leverage. And then, that capital is usually, like I said, the senior position is coming from maybe pension funds or, Lord knows where, sovereign wealth funds, or
some of our banks.
Some banks that are playing.
Yeah, they'll provide lines. A lot of these loans, a lot of the debt funds typically pool these loans together and will sell them in the secondary markets, and that's how they'll make it. Some of them just are using a line or they'll sell off the A piece, like you mentioned. They'll take the B piece of it. So many different vehicles that they use to get there. And I think, the benefit of those loans are that they're non-recourse and you're getting higher up on the capital stack at a fairly decent rate. What I would say borrowers should just be prepared for is the amount of structure that goes into them. And there's going to be cash management, and the fund control is a little more rigorous. And you want to make sure, the lender just, not to say a bank isn't sophisticated, but a bank going up that much on leverage is going to be very much involved in the deal.
Yeah, that definitely. Yeah. And that's what you see. And that's what you're referring to. Even the debt funds then in turn are much the same. I mean, they're willing to go up higher, on the advance rate, but they're like a partner. I mean, they're paying very, very close attention. And the statement of, it's not to say that banks aren't sophisticated, but lenders like that. And we had Boots Dunlap on with RA Capital would be, a good example of that. It's a partnership. And I think it's important to understand that, that those types of lenders, I mean, it's not just the money, right? It's that they're adding more to it. It adds additional rigor to the product. They sign off on it. So they believe they have some conviction over the business plan as well. So things to look out, meaning when you're an investor coming into a project, LP capital, in a syndicated deal or something, who the lender is does matter. And I guess that's sort of the thing to keep in mind, like who is the lender? Where's the money coming from there is often a good signal as to, because what we just heard, right? When you think about it, what we just heard was George Smith Partners, before they even get involved, they're underwriting the project, which you have to do to get comfortable to figure out how you're going to structure whatever the capital stack's going to be, because you're going to have to go sell it to somebody else. Right. And it's like, this is all of these. You got a lot of people you got to convince this is good, which I think does in the commercial real estate realm. It does add, there's some margin, there's some safety that comes from that. Right. But you got to know how to kind of peel back the layers. And sometimes those things get glossed over when you're reading an OM on a deal, like a syndicated deal. It's like, whatever. Like, I don't care where the, you're looking at the price tag, how much is the debt cost and what's the term. Yeah. Right. But there's other signs and signals there that if you learn to read them, they have meaning. And, and this is often why it's funny sometimes when people tout like, hey, we worked with so-and-so, it has all this meaning to them. But of course, someone else are like, it means nothing to me. I don't even know, like, who cares? Like, why is that a big deal? Because you guys don't take every project that hits. So you're, you say no like the rest of them, right? I mean, you're not willing to take everyone on.
We certainly want to be, judicious with our time. And we like to think of ourselves as outside CFOs for our clients. And so that relationship building is really important for us. And any transaction we're taking on, we obviously believe in it. And we think there is a market for it. And the demand's going to be there. And there's capital for it as well.
Yeah. So kind of shifting gears then to this, the co-GP side and the LP side, maybe just give us sort of cookies on the bottom shelf, like what that means and what you guys are seeing. And I mean, this is sort of, not to say like it's new, but it's a bit of a trend as to how much more sophisticated or how much more, the ways like I guess the way you put it before we hit record, right, was just like at the end of the, you could structure this whole thing, the amount of skin in the game from an operator developer, these days could end up being much less than it had been in maybe in the past. So maybe just give us a little bit of color as to what you're seeing and who those participants are and what that looks like.
Sure. And I think it's really interesting how the space has evolved. An LP is basically a limited partner, I think, in case any guests didn't know that. And the GP would be part of the general partnership. And so the returns are just different. The LP, usually the way you would structure a deal is you would bring in an LP partner if you were to bring one and not syndicate it. And the LP would do the deal with you at a 90-10 split of whatever the equity was. Now, and this has been around for a while, you can even bring in a GP with you, and the GP will, that 10%, they'll split that with you at a 90-10 split. So for a sponsor, you could be doing a $30 million deal with just $100 or a few $100,000 in it, which is just incredible if you think about it. And that really boosts your IRR at the end of the day and your multiple by leveraging it this way. Of course, now you're going to have a partner in the deal, which you have to get comfortable around. And each layer of partnership you're going to have to negotiate. And there's going to be control rights, where with lenders, that stuff just isn't as prevalent. And so, the one big difference between equity and debt is with debt, it's so much more transactional. We'll get a deal, we'll underwrite it, we're taking it out. Every lender kind of has this box. You fit in their box. You kind of, hit those marks, and they're gonna get comfortable with the transaction. With equity, not only do the numbers have to fit, but they need to get comfortable with you as a sponsor. It's much more of a relationship, because now you guys are truly partners. You're partners in the transaction. You're taking that loss together, and you have to believe in one another. And so there's always that relationship that you're building there. And it's for sponsors who are looking for that, it's something that you should start developing. It sometimes even before you have a transaction lined up. Really get in front of the equity and get to meet them and tell them about your business plans.
Yeah. So, one of the things I've seen with this sort of structure, it's interesting, is that, you've got a project, you're deciding that, okay, we're going to go find a sole, our preferences on this deal is to sort of JV it with a, 90-10, find one LP partner, right? Mm-hmm. You go out. Now those LP partners could be a family office, single family office, someone very wealthy who's get their mind wrapped around it, right? Could be one option. Could be a private equity real estate fund, right? That just does those deals. Yep. Maybe a insurance company gets comfortable with you and they'll be your LP, or sort of, maybe not.
Sometimes. That definitely exists.
So either way, you've got this party who's okay, we like the project, now they're going to try to cut the best deal they can, clearly. So they're going to protect their downside. We don't want to do an 8 pref. We want to do a 14 pref. We're going to do, whatever they do, they're going to just drive the best bargain they can drive.
And right. It's completely negotiable.
Completely negotiable. Every deal is different.
There's no cookie cutter approach.
So now this is where this is what's interesting, right? So they're okay, you guys need to come up with 10% of the equity. We're coming up with the 90%, right? That's basically the price of admission. We're not doing, 100% of the equity. You got to come up with 10%. So then you go to somebody else and say, hey, this GP requirement, it's $5 million, whatever, well, we don't have $5 million. So we now go and find someone else that's going to be willing to put in 4.5, right? Which is, and then we'll put up $500,000 or whatever the deal is. And of course, then that you said it's a negotiation of, well, we already structured the deal with these LPs, and this is basically what we're going to get. It amounts to 85-15 deal, right? So we get 15% promote, whatever the waterfall is. So now the other guys come in, and now off of the 10%, they're, it's going to be unpromoted. Obviously the GP investment, that 10% is not going to be exposed to a promote. How do you manage the fact that it could be one private equity real estate fund that's in the LP position, and then there's another fund that's come in the GP position? How are these guys deciding whether or not, because it seems to me that one's going to probably earn some promote, some percentage of the promote off of the other sole LP.
Oh, absolutely. The GP is earning the promote.
Yeah, GP's earning the promote, but if those guys are coming in and they found another partner that happens to look kind of like their LP partner, I mean, they do because some of these guys do LP, they invest as LPs or they invest as GPs,
And some GPs will do both. They'll be your GP partner, and then they'll raise the LP for you. So that's where the relationship's important. And you're bringing in the GP. They may be signing on the loan with you. A lot of them will boost up their balance sheet so you get a better loan as a return. Not everyone does that. Some of them will offer their expertise and services to make sure, by bringing that experience, they're able to really push the transaction through. And I mean, at the end of the day, by making sure that you're meeting everyone's return requirements, that's kind of how they get comfortable with one another.
Yeah.
And they're in different risk positions, right? So the GP, like one of the biggest challenges is getting a GP involved when you're lining up the land, for instance, and you want to put up that deposit. Well, you want to kind of find that GP partner then to put up the deposit with you and take some of that pre-entitlement.
Yeah, that's
whereas an LP usually just won't do that. You know?
Yeah. So it comes down to this, and this is where we get to the heart of it, right? It's like it's who can get comfortable with what the risk. I
right.
mean, being on the 90% LP, right? Like, you know, your level is like, we like the deal. We've obviously negotiated around that to ensure we protect our interests, but you know, we didn't have to deal with all that other stuff, the pre-entitlement, all that other stuff. You know, that wasn't. We weren't explorers. We were never pregnant with that risk because we came in after it happened.
Right.
And it's very, because you see, I mean, this is why I get a lot of people, and this is where, you know, we are getting a bit into the weeds here, but I think it's, you know, it's interesting stuff. You know, a lot of guys come in, sponsors, developers, operators, whatever, and they're like, I want to raise a $500 million LP fund, right? So what they mean by that is they're saying, I'm going to raise a giant fund that I can just transact out of entirely, right? Like, and I understand where that would come from, right? Like that definitely would seem like that would be heaven if you could somehow do that, right? Because now you have all control, you know, like you convince everyone to buy into this economic framework, right? Whatever it is, and they buy that, and then you get to go transact. But it never works out like that. It doesn't work that way, right? It's because of these things that there's so many access points now. There's ways to participate at the deal level. Everyone wants to kind of pick and choose because they have some structure upstream, you know, that their mandate, or that everyone's dealing with some mandate, right? And so no one has the notion of full discretion is a bit of a misnomer. It's more nirvana, you know, it doesn't really exist. So I think it's important to understand that, you know, that these are the different doors that you can go through, but they have their own risks. Because one of the things that I'm encouraging a lot of, you know, operators especially is, you know, okay, just get the 300 million or $500 million LP fund out of your mind. Just start a fund, like a GP co-investment fund, right? To bring in the best investors that you have today, right? Because one, now you've got a fund. Two, you can use that fund to handle some of that entitlement stuff, right? Pursuit costs, earnest money deposits, you know, and you can use the same formula. And now you can go and find more, you know, institutional or quasi-institutional LPs to maybe be that, or you could syndicate it, or, you know, you've got a lot of flexibility then as to how you can participate when you do have a little bit of discretion over at least some amount of funds that allows you to transact more frequently and more efficiently.
Absolutely. You got to walk before you run. You know, jumping to that level takes time. And I think like a very select group has that ability, right? You build your reputation, and I think over time you're able to, you know, as you build on your success, you get there, right? Where you might have a programmatic relationship with someone who'll commit $100 to $200 million to you because they see what you've done in the past and you're now at that level. But it takes time to get there, for sure.
Yeah, it does. And I you know, I've been in the business since 2008, so not as long as you, but it just, I've never seen anything that looks like a hockey stick in this business. There's just the notion of some exponential type of growth. What you do see is you see some amount of, you know, it's very linear, right? The line is so straight, and then some people, their line is, you know, got a steeper angle than others, right? And I think that's it. This is a long game for all the participants. All of these things have built-in sort of things that stop you from being able to go like, you know, crazy that way. You know, it's just the way that it works. And so understanding where you're at on that, and then also, and that's what I mean from the passive investor standpoint of just being able to assess where people are, right? Like, it doesn't mean that people with a limited track record are bad and all the people that have been transacting for 30 years are good, right? It's not that simple. right? It just doesn't work like that, right? You need to understand that, yeah, the good news with sort of the emerging sort of the emerging sponsors or those that are, going is the good news for you as an LP is that you're going to be able to cut a better deal, right? Like they because they know they need to demonstrate and create that track record, right? And so it's like anything. It's just you've got the emerging markets and you've got those that are that are stabilized, and that the guys that have been doing it forever, they start to get more power in the transaction, right? Because the certainty goes up and their ability to execute and their cost of capital should start to go down. Would you agree with that?
Oh, 100%. I mean, listen, we have clients that we've built from, doing very, very small transactions to now like $100 million plus deals, where that over time, over the span of 12 years, they got there. And I think at the same time, like, you have these emerging developers now that are coming and they want a co-GP and they want an LP, and they worked at a great shop for a long time. They have a lot of experience. They know exactly how to find the right deals. They could tie them up. They have some equity, but to do a $30-40 million deal, they're going to need capital partners. And while they have experience, they don't have enough experience on their own to say, like, I built this with my own capital on my own. So they got to start somewhere. And on those deals, you're right, the LP and the GP will have a little bit more say on what they're going to get. Whereas as you build experience and really get a track record, you're going to be able to direct that conversation a lot better.
Yeah, that's right. And when you pan out, I think the translation of all this is just to understand that. And I always say this, like every episode I have to like harp on this, but it's like, okay, this business is very, very, very relational, right? Like, this isn't. Although it from the outside looking in, it can look very transactional, and in many ways it is. There's transactions at the heart of these things, but it's built on the strength of individual relationships. And what that means to an average passive investor is you need to understand that there's certain, it's access to deal flow, right? So I know we all love the notion of sort of real estate crowdfunding. It's the greatest thing in the world. Like, okay, I'm as excited about it as the next guy, and I have been, right? Like, we filed and checked the 506C box the day that you could check the box, right? So, I mean, I'm all for it. It's great, right? Democratization and everyone has access, but it's like what you need to understand is that all the way up and down the stream, the value stream of how these things get done is that, the doorways that you can enter to get into deals at whatever level you're into, right? As we've just discussed in this very short period of time, there's all sorts of doors and ways to get in to the capital stack of any given transaction, right? And so the ability for you, wherever you are, to get in and just be at a computer and push buttons and just get access to really, really high quality stuff and good deal flow is just a myth. Right. It's that you have to go out and build relationships yourself. Everybody does, to sort of get access at the right point that fits your risk profile. Right. Like even getting into a debt fund that lends to people like this, or getting down into the potential to invest in the GP slug of a deal or whatever. They don't just let everyone and their brother, like, hey, everyone pile in $1,000 minimum. Right. Like it's just. There's so many doors. Now, from my standpoint, as sort of like the back office provider, and a tax practice and all this stuff, it's the beauty of it, because these are all partnerships. So all these things are like linked up and connect to each other some way, right? And so every time you turn around, there's another LLC that has to have a tax return done and capital accounts that have to be maintained and all these sorts of things. So for us, it's the beauty of it, right? Is that there's all the stuff behind the structuring that has to be maintained and taken care of, right? To make sure that it all sort of fits together and it's all being done, and
you're exactly right.
But that's how it works.
And the relationship element of it is so important. I'll say, like, when I joined this company, I built on the relationships everyone before me built, and I used that to start building my own relationships with capital providers and then clients and so forth. And that goes such a long way. Being able to call someone and have them call you back is critical to your success.
It is. And so if you're not, and I think that's just now in the sort of post-COVID world we live in, and obviously the vaccines are there, and and I'm assuming that things will get back to more normal, but it's still, if you're not picking up the phone and having substantive conversations, I don't care where you're at. I don't care if you're just retired as a dentist yesterday or whatever. If you're intrigued by this business, whether you want to be passive or you're passive and you want to become active and you want to get involved, if you're not having substantive conversations with people and talking about these sorts of things, then you won't get in the game, or or your participation will be at the edges.
Yeah.
Right? And it's just,
exactly.
that's how it works. And the reason I just keep harping on this is because I think that everyone wants to think that that's not how it works. They want to believe that we're already at this place where I just push buttons and I get into things, and that
your first phone call is going to turn into like the dynamite deal, and that's it. Now you're a real estate investor and you did it. It's that easy.
No,
you can send someone an email and they're going to do your deal.
This business is full of grinders, right?
Yeah.
Everyone in this business is basically grinding, and the guys who get it are the ones who know that you don't win the game in one swing or whatever. Like, these are the guys who are they're more of marathon runners.
Yeah.
You know what I mean? And it's like they enjoy the grind. They get up, they get after it. You get kicked down, you get knocked down way more than, you're on the ground most of the time looking for stuff or whatever. That's what this is. So it's great to talk about multifamily syndications are wonderful. It's the greatest invention ever. And I mean, it is. Obviously it's been around forever. So it's neat, but really getting in the underbelly of how this whole industry works. And that's sort of the innovation, is the fact that it's just been opened up, right? Like it now, it's not just Goldman Sachs and Wall Street and whatever. I mean, it is now everywhere.
Yeah. Right? And you touch on it. It's even in crowdfunding, and you have access, Yeah. And people can be in deals, and that's great. It's great. It's great that we're at that place now, and I'm sure that's only going to grow.
Yeah, totally. Yeah. It's going to grow from here. And it's exciting. Like I tell people, I feel like this business is sort of where venture was in 2002, 2003. I mean, it wasn't that long ago. I know it's just really, really hard to imagine, but there was a day not that long ago when people didn't know what an angel investor was.
Yeah.
Or they would say, what is an angel investor? You thought it had something to do with some medical, you thought it had some some I don't know what people thought, they didn't know what it was. Right. And so it's when you look at how that industry, which I consider adjacent, right, sort of to this real estate space in terms of how it gets capitalized, a lot of the things that happen there are now happening in this business. Just the proliferation of providers, absolutely. And just, all these different sources. And it's really cool. It's cool, I think, for guys like us, because now we're in the thick of it. Right. And in the primes of our career. So it's a lot of things have just moved and you kind of missed the boat on it, but this is happening, we got to be part of it.
COVID slowed it down, but I think it's allowing people to just transact so much faster and so much more.
Yeah.
Transaction volume is just through the roof on every level, whether you look at the capital, debt, and the innovations they're making, or you look at, doing deals and just syndicating equity. You're just able to do a lot more as time goes on, with that technology.
Yeah, no, it's cool. It's exciting. So I'll let you go, but where can people find you?
So they can email me at syazdi, syazdi @gspartners.com, or call me anytime, 310-867-2954.
Cool. Well, thanks so much for your time. It's been fun. Like I said, you were the first of your kind on this show. So we're sort of cutting over to the other side, and I appreciate
always good to be the first.
That's right, man. Yeah. You're breaking barriers here.
Yeah.
Real estate risk report.
All right.
Cool. All right,
Thank
man.
you, Lance.
Take care.
Bye-bye.
Bye-bye.